When it comes to fixed income for this year, we're not very optimistic on returns for fixed income investors, specifically in long-term bonds. We don't expect the same type of double-digit declines in the broad fixed income market that we saw in 2022. The Bloomberg Aggregate Index actually saw its worst annual decline that it's ever seen on record. We're not expecting a repeat of that, primarily because the Fed has front-end loaded those Fed rate hikes, and we're actually going to start talking about them slowing them and potentially then stopping them in the middle of this year. But we don't think that the long-term part of the curve, so think about long-term bonds, 10-year plus, these bonds aren't reflecting the current environment or the interest rate environment. When you take into consideration inflation, real yields are still historically low, and we think have more room to move higher to reflect the interest rate environment. When it comes to credit, this is an area of the market we do not believe is fully reflecting the risk from an economic standpoint or a default risk. And when you look at this chart, when you take into consideration spreads or that extra yield you're going to earn to own high yield or investment grade debt, to take that credit risk, it still is very low in a historical context. And we realize that many people may say this time is different and corporate balance sheets are much healthier, but it's very difficult when you look at this chart to look at every recession and even economic slowdown does coincide with some increase in spread widening. That's when we will be there to be looking for the opportunity, and we do think it will happen this year. The other thing is that we don't believe that it's fully reflecting the refinancing risk that's going to be coming in the high yield market in 2024, 25, and 26. As you can see on this chart, this is showing you the amount of debt that needs to be refinanced. Well, guess what? It's going to have to be refinanced at higher rates. This is a risk to the market that we believe will start to be reflected in 2023. That's where the contrarianness will come in, and that's what we will go in and look to increase exposure from a credit perspective.